Hi there folks, welcome back. As a financial planner, every once in a while I run into an investor who has 100% of his or her portfolio simply in the S&P 500 index fund. And although there are worse portfolios, and that's not a disaster, I would like to share 4 reasons why I think every investor ought to include other things besides just the S&P 500 in his or her portfolio. So in this presentation, at the very bottom of each slide, I've included an agenda, and I will highlight along the way each step where we're at in relation to that. So let's get started. So the first 4 reasons, first off, the S&P 500 is capitalization weighted. It's technically a float, and we'll cover that in more detail. The second reason why investors ought to look beyond just the S&P 500 is that the U.S. is only about 20% of the global economy. Third, stocks are only a fraction of the capital markets. Many people will be surprised to find out that the stock markets in general worldwide are actually smaller compared to other capital markets. And finally, stocks are more volatile than other asset classes, so are not suitable for all investors, and we'll discuss in more detail. So first, what does capitalization weighted mean for you and your portfolio? In capitalization, that just means the number of shares outstanding of the company multiplied by the current share price of that company. And there are different formulas that make up that calculation, but we'll just keep it simple and say, okay, it's the total number of shares times the share price. That means bigger companies like Google and Apple will actually make up a larger portion of the index. And it makes perfect sense for an index. But we'll see here that it doesn't necessarily make all that much sense for an investment portfolio. And off to the right, I've got a pie chart that I've shown the 10 biggest companies actually represent about 20%, not quite 20% of the index. In other words, we've got 10 companies constituting about 18% of the entire index. That means the other 490 companies make up the other 80%. So you can see that it's more skewed towards those larger companies. Second, the second piece here, that the U.S. is only a small percent of the worldwide economy. Although it is one of the largest economies in the world, it's still only about 1/5 of the global economy. So here I've got a chart representing several different things. On the x-axis or horizontal axis, I've got the GDP, that's nominal GDP in US dollars. Then on the vertical axis or y-axis, I've got the estimated growth rates taken from the International Monetary Fund's economic outlook for 2015. And then the actual size of each bubble represents the size relative to the global economy. So you can see the United States is just over 20% of the global economy, but you've got other large economies. And you can see that all these different economies have different growth rates and different sizes, and really all we're looking at here is that these other countries and other economies represent opportunities for inclusion into an overall diversified portfolio. Tag on that is including non-correlated or non-perfectly correlated assets into our portfolio. We know that that helps reduce risk and maximize return. So it overall helps your performance long-term in your portfolio. So off to the right here, I've got a chart showing the different beta coefficients for various various countries relative to the world beta coefficient, which would be 1, right? And you see the global beta coefficient would be 1. US is just shy of that, Brazil significantly above that, and you can see across the board all these different countries. And I've just listed a few here, but what that means is these different countries are not perfectly correlated. So we can look and say, okay, if we include some investments from some of these other countries, that could potentially help reduce risk, maximize return for the portfolio. Third, stocks are only a small part of the capital markets. The capital markets, McKinsey and Company estimated that the global capital markets as of 2011 were about 212 trillion. So about 25% of that is coming from the stock markets. The other 75% is actually coming from the debt market. In other words, some countries will have a debt market, but not all countries have a stock market. So you can see that the market for bonds, corporate and government debt is actually quite a bit bigger than the stock market. So there's other opportunity besides stocks, which constitute the S&P 500. So finally, the volatility of stocks versus other investments. Stocks are typically more volatile. They have higher growth potential, but also more ups and downs in the short term. So here's I've got kind of a basic chart. This chart makes its appearance in all sorts of different ways, just doing kind of a quick Google search. You can see this spans many, many years, clear back to where we don't really even have that good of data, but you can see the estimates for stock market gains and losses. They're more pronounced on the short term, but over long term we've got a higher growth potential. But not all the investors have that time horizon. Not all investors have the risk tolerance to withstand such ups and downs. So 100% stock exposure or portfolio just in S&P 500 isn't suitable for all investors. Finally, this is not a discussion on efficient market hypothesis, or whether you believe in semi-strong or strong form of the efficient market hypothesis, or whether you're a passive investor or believe in managed money. This is not that discussion. What this really is saying whatever your beliefs are on efficient markets, there is a place for other asset classes beyond the simple S&P 500, which represent large cap domestic stocks or the 500 biggest companies in America. There are other mid-sized and smaller U.S. companies even within the United States, and of course companies domiciled around the world. And second, as we've reviewed, the U.S. is not the only player in the global economy. It's only about 20%, just over 20%, so there's growth opportunities internationally. Third, there are also other asset types, such as government debt, long and short term. We've got corporate debt, long and short term, real estate, precious metals and minerals, etc., etc. And fourth, stocks are more risky, although they do have higher growth potential. That's not suitable for everybody. So hopefully this has been valuable for you. These are some things that I've learned in my years as a financial planner. Here includes some notes, and I will make this presentation in a way that available to you in addition to this video, way that you might be able to search it and go through it at your own pace as well. Thanks for joining me, and hope this has been enjoyable. Take care and best of luck with your investing.